I think that there's still a lot of uncertainty in the world and in the markets. And so I'm generally concerned that there's a lot of chop. And so I pick something that's pretty conservative, but I would have a combination of cash and the front end of the yield curve. So T-bills all the way up to 2-year bonds. So you can generate 4.5%, probably by the end of this year, 5% pretty safely owning this stuff while you wait for things to become more certain. And the way that I think about it is that I would rather miss the first 10 or 15% of a rally once we're really done with this stuff than try to overcorrect and try to pick a bottom, just because I think that you could lose a lot of money. So I think the goal for this year is to stay resilient and in the game. And so having a bunch of cash on the sidelines ready to pound it in. Meanwhile, a portion of it collecting 5% is not such a bad thing while you wait for the bottom. If we've learned anything from the last 3 years, you have to separate the valuation of a company and how it performs in the stock market with its value in society. So for example, if you look at Zoom's valuation has cratered, but its value in society has probably continued to go up. It's still a massively relied upon tool. The point is that markets do not give you credit for the value in society. They will give you credit when you are about to over-earn, but then they'll pull it all back when they think that you're going to under-earn. So in that lens, I think that tech will have a tough year. I think energy will have a really shit year. And probably the biggest asset class that is going to get pressured is going to be junk debt. And the reason is a bunch of these variable rate loans, when rates are at 5 and 6%, that all of a sudden are like 11, 12, 13, 14% coupons, a bunch of companies will have trouble meeting their debt obligations and will have to restructure the debt or will have to file. Inflation, which people expect to fall off a cliff, doesn't fall off a cliff as fast or as meaningfully as people want. And so I will explain inflation as 3 different chapters, and we've seen the first 2 chapters play out. So 2021, chapter 1 was all about energy inflation. And, we all talked about having almost $10 gas at the pump and what does it mean for everybody? And it caused that initial spike in inflation. And then we had it come off, and Sachs called this. He said, we're going to have this sort of double hump. And 2022 was really the story of goods inflation, right? All these prices and all of these things went up because the input costs went up, and we all had to bear the implications of that. But then that started to ebb. And now, if you looked at the tail end of 2022, what I found super interesting was the number of articles I saw about wage inflation. Whether that was Biden using an 1800s era law to prevent a railroad strike, the number of states that increased minimum wage, the trend around unionization. So in general, my thought is that the pendulum is swinging very markedly away from capital and towards labor. And as the labor participation rate stays low and continues to go down, and also it's compounded by an unemployment rate that may go up, right? It's going to be harder and harder to get people to do the work you need at the company you have unless you pay them more. And if that gets exaggerated, then inflation will stay where it is. It won't be as muted and it won't fall off a cliff as people want.
It'll be persistent.
That's my big contrarian wager for this year, is that
that is quite contrarian.
We see wage inflation that keeps inflation not going down as much as people want. The shitty thing, by the way, about your selection is that Biden, our explicit stance is unfortunately quite confrontational with MBS. And you saw that play out in Q4. We asked them to ease up on OPEC Plus to introduce supply cuts, and they did some nominal 100,000 barrel per day cut. Didn't do much of anything. There was an article, to your point, Freeberg, just recently about Saudi really doubling down on getting the oil out of the ground and monetizing their petrochemicals. So there's just going to be a glut of supply in the market. And we have the least amount of influence with Saudi Arabia than we've ever had And it seems like we could change that if we decided to. But I think Biden has taken this very confrontational approach, which doesn't seem to make a lot of sense. They were all clean markups. So the 4 deals that other people put money into. And I was looking at them and I was trying to figure out, okay, what differentiates these things? And Freebird, to your point, these were super clean startups with very clean cap tables that had clear progress. And then conversely, I had 7 converts showed to me for companies whose valuations were anywhere between 3 and I would say 12 billion. And I did none of them. And not only did I do none of them, nobody else did any of them. And the problem was the real market clearing price was 80 to 90% down. And so I was like, what is going on here? So Freebird, to your point, I don't even think it's just cash intensive startups. I think it's like all growth companies are in a really bad place. I thought that this growth stuff would get sorted out in 2 to 3 months. And now I'm worried it's 2 to 3 years. At the beginning of October, I think what we basically said, kind of generally speaking, is markets up, right?
Markets up.
We went from nibbling to being constructively positive and basically being positioned long. Here's this really interesting setup. We have a bunch of very positive news that I think we all have to process. First positive news was that inflation ticked down. Now, here's what I'll tell you. There's a caveat here. I talked to a bunch of pretty smart sharps on Wall Street. And, 2 things. Number one is they all gave credit to David Sachs. And they said, Sachs was totally right. Double dip recession is coming. But then they said, tell Sachs that we think that these are the sharps. We think that there's a double hump in inflation coming, which means it's coming down to come back up. And there's a bunch of reporting vagaries that may cause that. So keep that in the back of your mind. But positive news, number 1, is inflation ticking down. Number 2, Jason, we talked about this. A federal judge basically stayed Biden's attempt at giving student loan relief. Now, that would have been a $500 billion transfer payment from the government into the hands of individuals. It is deflationary to not give that money to people. It's effectively taking stimulus away from folks. Number 3, it looks like we're headed towards a split government, which means that we are not probably going to see any more stimulus over the next 2 years. I think if you take them together, what it says is that, wow, there's the potential for a lot of great positive developments over the next 6 or 9 months. And I don't think that was adequately priced in the market. But here's the problem, and this is why we've been rallying. The problem is that most of this rallying has been because of a bunch of short covering by folks who were pretty pessimistic and negative after the last few inflation prints. So this is not really net new buying that we saw over the last couple of days. So you take it all together, I'm like, it's still going to probably trend up a little bit. But then again, we talked about this, Jason, when the VIX gets into the low 20s or the high teens, that's probably the short-term top, and then it turns around, and unfortunately we're near the low 20s, high teens. So that's kind of my thought on things right now.